Hello and welcome everybody. My name is Lutfey Siddiqi and I'm delighted to be the moderator of today's panel discussion on China's financial system. As we look at China from outside, it looks like there's a lot going on right now. The country's digital yuan recently began its first trial and will likely begin its national rollout soon. This might have implications for traditional trade, e-commerce, and the US dollar's global standing. From trade war to the tragic pandemic, the trade account between US and China is still looking for an equilibrium. On the capital account, China appears more welcoming of foreign investment into stocks, bonds, and even directly into local firms. And as we speak, is grappling with some market volatility. To those of us looking from the outside, it feels like both at a macro and a micro level, this might be a consequential year for China, for China's financial sector and its implications for the rest of the world. I'm delighted to be joined by an expert and distinguished panel to shed light on this topic. I will introduce each one of them as I invite them to make some opening remarks. But first, some housekeeping. This is being recorded and the audio and video will likely be made available online. We'd like this to be as interactive as possible, so please feel free to ask questions using the Q&A feature on Zoom. Please give us your name and affiliation as you ask your question. After the first round of comments and the second round of responses to my questions, we will quickly move to Q&A from the audience. Okay, so let me introduce our first speaker, Joyce Chang. Joyce Chang is Chair of Global Research for JP Morgan's Corporate and Investment Bank, and she's a member of the Management Committee of JP Morgan's Corporate and Investment Bank. JP Morgan's global research professionals study all sectors in which the firm does business, including equities, fixed income, currency, commodities, emerging markets, derivatives, and structured finance. Joyce, welcome. Thank you for being here with us. Could we have your opening remarks, please? How do you see the outlook for China's financial system this year?
Well, thank you so much. It's such a pleasure to be with you today. I thought I would just make 3 points in the introductory comments. First, just go over JP Morgan's forecast for China this year. Secondly, then talk about China in the international realm, how we see their international relationships developing and where the financial sector fits in, and then talk more specifically about the financial sector opening, spending some time particularly talking about the bond market, since my background is in fixed income. So at JP Morgan, we are forecasting that China will grow 9.4% this year. We do think that in contrast to the United States, there is more of a focus on policy normalization, taking down the size of the fiscal stimulus, and concerns that the amount of debt that has accrued as a result of the pandemic will be something that's problematic later on. So I think there's deliberately some cooling down of the economy after really putting on quite a lot of stimulus during the pandemic. So we are forecasting, though, when you take a look at how the pandemic has reshaped China, a fairly dramatic change with respect to when China reaches the size of the US economy. So in 2019, before the pandemic, we estimated that China was about 2/3 the size of the US economy. But China was the only country that had positive growth last year at 2.3%, with the 9.4% this year. And also the currency appreciation that we've seen, we think that China is now more than 80% the size of the US economy and will match the size of the US economy before the end of the decade. In 2019, we saw that China's nominal GDP weight had overtaken the euro area. We still think that GDP could still be on track, to double by 2035 and beyond, even accounting for the slowdown in potential growth that we see going forward to more of a 4.5% to 5.5% range. So still a very high headline growth number this year, but in the next 3 quarters, we actually see the pace of growth in the US, because the stimulus that just passed the 1.9 trillion at a faster pace than China. So that's just it on our macro forecast. Let me talk a bit about just U.S.-China relations, China's relationships with Europe, and where the financial markets fit in. So we would characterize China's strategy as really focusing on playing for the middle. And what I mean by that is, because you have had heightened tensions between the US and China, we think that China really is playing for the middle. And some of the recent agreements they've forged point to this, and that includes the Regional Comprehensive Economic Partnership that was signed between 15 Asia-Pacific countries last November, and also the EU-China Comprehensive Agreement on Investment. And what that really is trying to do is create a level playing field, open up market access. It focuses on climate and the environment, but I think very importantly too, it strives to make sure that there's a bilateral relationship where the Chinese market for many EU investors had been closed. So what it does is it seeks to create a level of openness in banking that makes future rollbacks unattractive, while market opening in financial services should be negotiated on a most favored nation basis and should be beneficial, for the rest of the world. So we do see just signs of that agreement for opening the financial services. I think that under the EU agreement, the investment agreement as well, China's state-owned enterprises need to engage on the basis of commercial considerations, as any private business would, and they're not supposed to discriminate against EU companies in their sales or purchases of goods and services. Just to say a few words on the US relationship. One thing that we do think will remain intact is the Phase 1 agreement that was signed under the Trump administration. And the USTR head, Catherine Tai, had worked actually quite closely on that when she was at the House Ways and Means Committee. And the Phase 1 agreement is noteworthy because there are many areas of tension with China on human rights, democracy, technology, but the Phase 1 agreement really did call for more opening of the financial sector. And so that's something that very much has been basically kept intact. And in the Phase 1 agreement, China abided by its commitments, including the removal of ownership restrictions, the expansion of business opportunities for foreign financial institutions, eliminating some of the joint venture requirements, allowing majority ownership. So even though US-China tensions continue, we do think that that financial cooperation will remain and that the elements of Phase 1 will remain in place. So then to focus more on the opening of the bond market in China and how we're looking at the way that market is developing. First, I would just say that when everybody talks about the tail risk of a financial war in China, I think that tail risk is very, very low, and that is whether the U.S. would block access to Chinese banks and companies to the U.S. dollar clearing and settlement system, or whether U.S. treasuries held by China would be weaponized. And I do think that these scenarios are very low under Biden, and I do think the Phase 1 agreement will remain in place. But what I would have to say is that in total, under the Trump administration, they introduced more than 200 actions against China in the last year alone. And if you look at the 116th Congress, there was actually 467 bills, of which 14 of them had passed. So I don't see the removal of trade tariffs coming up, and I do think that some of the sanctions, are going to remain in place. And I don't think the tariffs will remove that quickly. New tariffs won't be introduced. I think any removal of trade tariffs would need to be reciprocal, but the financial sector opening continues. And a key area that we have worked on at JP Morgan is China's entry into the mainstream bond indexes. So this process had started with Bloomberg Barclays. JP Morgan completed this process at the end of next year, and this will start with the FTSE in October. Now, China has the second largest bond market in the world. second only to U.S. treasuries. So this has big implications for inflows into China. We estimate that potentially 275 to 310 billion of flows could go into China just off of rebalancing the indexes. And last year, we had inflows that, as this entry into the index was really just coming into the mainstream, were probably in the order of 150 billion. We're looking at a slightly slower number this year just because the FTSE the FTSE inclusion doesn't start until October. But we have seen monthly inflows that are very large into China's bond market, and we still see that foreign ownership of Chinese onshore assets still is very low at only 3% of the country's $16 trillion bond market, even though we saw about a 41% increase in the China interbank bond market over the past year. The other question we get a lot of inquiry about is China's digital currencies, and I do think that China will continue with developing alternatives to the dollar for their own domestic purposes, but I'm more skeptical on how quickly this will gain international adoption, because China's capital controls, I think, still make it very difficult to see how they're going to get over some of the cross-border limitations that they have right now. So I think that the financial openness has been one area that has not faced some of the tensions with U.S. relations that we've seen in the tech sector, other areas between the U.S. and China. We think the economic story still continues to show a very strong outlook post COVID-19, and a commitment to the international opening of the financial sector, as seen with the agreements that have also concluded with Europe over the last few months. So let me stop there.
Thank you very much, Joyce, for those remarks. I will come back to you with a question, and it's likely to be, let me give you a feel for what it's likely to be. It's I hear you when you say that the tail risk of a deliberate escalation of US-China conflict, the weaponization of treasuries, is low. And I also hear you when you say that Chinese growth of 9.4%, the only economy to have grown last year, so fairly strong fundamentals. Those are positives. But a concern you often hear about from the outside is whether it is accruing debt imbalances and the unknown around the growth of credit. And if it's accompanied by more openness and more opening of the capital account, could that tip things into the risk scenario, particularly when we're expecting a large flow of money into fixed income through these index rebalancing actions? So I'll come back to you with that question. For now, and as Joyce mentioned, digital currency, which gives me a great link into our next speaker, from macro to micro. I'd like to invite Lucy. Lucy Gazmararian is the founder and managing partner of Token Bay Capital, a fully regulated alternative investment firm based in Hong Kong, which is focused on identifying niche investment opportunities in the digital assets and blockchain space. She's also co-chair of the FinTech Association of Hong Kong's Blockchain Committee. Lucy also founded Women in Crypto in Hong Kong. Lucy, welcome, and your perspective, please.
Oh, I've unmuted myself. Can you hear me now?
Yeah.
Great, thank you so much. Thrilled to be here with everyone this morning, UK time. So yes, I prior to founding Token Bay Capital, which indeed is looking to invest in digital assets and blockchain companies that are focused on really building the new financial markets infrastructure for our new digital economy. So it's not a Bitcoin or crypto fund, but actually we're seeing a fundamental shift in the way financial securities travel across the whole world globally, right? And a very important piece of that is obviously money. So money is a very important value transfer around the world. And so digital currencies is a really exciting area of innovation. So prior to founding Token Bay Capital, I was at PwC's crypto team based in Hong Kong. So PwC has a dedicated crypto team. And as it relates to the topic of the discussion today, I was working on the project with between the Hong Kong Central Bank and the Central Bank of Thailand on their cross-border digital currency. And that was a collaboration between PwC and Consensus, which is a blockchain consulting firm that builds and develops applications exclusively on Ethereum. And we brought together a number of different corporates in both Thailand and Hong Kong, as well as 18 financial institutions, all to really discuss how a cross-border digital currency should look, how it should be designed, how it should work, what are the implications for the banking system and the payments system as it stands today between different countries on a cross-border basis. But also thinking about how corporates are involved in this too, because to take a step back, the digital currency innovation is extraordinary in that it's enabling peer-to-peer transfer of value. So all of a sudden we have technology that can essentially bypass the existing payments infrastructure that we have in place around the world. And that is, that's an innovation that has to be managed very carefully, right? So we are very aware that we have the technology and solutions to really make payments instant, free, completely frictionless. And most importantly, for the purpose of this panel this morning, to completely bypass the US dollar and the corresponding banking network, which the US has used to weaponize, if you like, the US dollar since the end of World War II. So we're really at an incredible inflection point when it comes to the history of money. And, it's not just the Hong Kong, the HKMA over here and the Bank of Thailand experimenting with this new technology and cross-border digital currencies. We know that 80% of central banks around the world have been exploring and looking at this technology for the last 5-6 years, with China completely leading the way. And I've heard firsthand from the Director General of the Digital Currency Institute at the PBOC, and he said, when he was asked why China came up with the ERMB, they have said that it was very much in reaction to the threat of Bitcoin. And suddenly Bitcoin brought to the world this incredible decentralized technology where you could securely transfer value around the world without going through a central intermediary. And central banks realized that they could adopt much of this groundbreaking technology to upgrade payments and the transfer of value all around the world. So all of a sudden it's becoming actually a geopolitical topic. Digital currency is incredibly exciting. And the reason why it's so exciting, just on a base level, it's able to make payments so much more efficient. But actually what we're talking about is elevating money to an entirely new instrument. All of a sudden, we have money that is code, it's software, it can be programmed in completely new and innovative ways so that any user of the currency can spend it in specific ways or not spend it, right? Depending on the central bank that's in control of the underlying architecture that supports the currency. So it's really, central banks are being given a blank sheet of paper to design new money that has functionality that we can't even really grasp at this point. So, the big question is, with China completely leading the way, we've had the reports of them airdropping these new digital RMB tokens, which I love the fact that they're airdropping. Anyone that knows a little bit about crypto, there was this whole sort of airdropping of tokens. So it's interesting that central banks are actually adopting this. But when I say airdropping, the central bank can just deposit these new digital RMB tokens into digital wallets where users have downloaded the associated digital wallet. And they're being asked to use and spend them in various ways and test the resiliency of the system. But, the jury's really out as to where this is going to go. And, in terms of, are we all going to start using the digital RMB? I think it's a really interesting question. I would say it does pose a distinct threat to the US dollar, simply because the US is lagging in their digital dollar project, right? So everybody knows now that money needs to be upgraded, because money needs to be able to operate within a digital economy, within smart cities, within IoT-driven devices, machine-to-machine payments, automated payments. We know that this is now necessary. It's the one missing piece of our digital lives. And so I do think that it's going to pose quite a threat when people start using something, and they'll use it because it's so easy. And they may not be using it in the West, because I think the biggest concern that we have when it comes to digital currencies is the privacy aspect. Are we being tracked? Is every payment that we make being tracked by a central authority? And the answer is yes, it could be, depending on which central authority you're talking about. But if you're looking at the existing payments infrastructure, for example, in the Belt and Road region, where you've got 17 new countries all building infrastructure, a quarter of the world's population, a third of global GDP is innovating, building, it's a greenfield site. It's in distinct contrast to the West, where the infrastructure is being built and it's just failing. So when all these countries from Uzbekistan, Kazakhstan, China suddenly have the ability to transact using a universal currency instrument that is immediate, it settles instantly, rather than routing through to a bank in New York, taking 3 to 5 to 7 days to clear, why wouldn't you, for that pure reason alone that it's just so much more useful from a business perspective, and time is money, we could find that the ERMB is adopted in huge swathes of the global population. And I think actually China now has a task on its hands, a sort of PR task on its hands, because their initial launch of the ERMB is a digital retail domestic currency. So they're testing it, they're trialing it with Chinese citizens, but the view is to then expand to have it flow outside its borders. And when we talk about capital controls and the RMB being a tightly controlled currency, that is indeed true. But this technology enables you to uphold capital controls far more effectively and efficiently, because it can be programmed into the code so that you actually can't spend money if they don't want you to spend it in a certain way. So it's really extraordinary times that are coming up. And we now know that the digital currency project that I was personally working on with the Hong Kong Central Bank and the Bank of Thailand, the PBOC has joined that. So it's now a multi-currency solution that's being tested. So it's no longer just bilateral. And the Central Bank of UAE has also joined. So the idea is, we can now experiment with cross-border trade and payments between many different countries. And again, it can all happen instantly, and it bypasses the US dollar. So I'll stop there. I do think that it is an unbelievable time in the history of money. And, the backdrop to central bank digital currencies is, of course, private currencies with things like the Libra coin, and completely decentralized currencies like Bitcoin. So we have all these new sources of digital currencies, these new ways to transfer value between individuals across the world instantly. And it's going to be very interesting to see how all this innovation is contained and controlled, if indeed it can be. So I'll pause there.
Thank you so much, Lucy. I was quite taken by your painting this vision of a Belt and Roads driven ERMB block, in the same way that we have a Eurozone block and a dollar block, and whether there could be an ERMB block in those countries. My question to you will be around, so I'm still a little unsure as to net at the end of everything that you've said, whether there is more trust or less trust in the digital currency. And how do you conduct monetary policy with digital wallets? Do you do quantitative easing by sending people money directly or not? But I guess my question is really, can we have this central bank-led digital currency and at the same time have private sector cryptocurrencies in that same ecosystem? Or is the intention to drive out the private sector involvement here? What do you think is the regulatory environment for the private sector initiatives in China? So I'll come back to you with this question. And now, next up, Geoffrey Yu. Jeff and I worked together about 5 years ago. Delighted to see Jeff here today. He's a foreign exchange and macro strategist for Europe, Middle East, and Africa at BNY Mellon Markets. He's a well-known analyst on global asset allocation, but Jeff is also a specialist on economic and political developments in China. He formerly served as the UK CIO for UBS Wealth Management and a senior foreign exchange strategist for UBS Investment Bank. Raised in the UK and China, very, very importantly, Jeff is an alumnus of the London School of Economics. Jeff, over to you for your opening remarks.
Thanks very much, Lutfey. So just with my markets hat on, I just want to talk about financial conditions in China right now, because this is the single most important thing that all central banks globally are focused on right now in managing their economies towards recovery, towards reopening, and making sure that we're back on a path towards sustainable growth while limiting economic scarring. If you look at the PBOC's commentary, we would note a marked change or a flip-flop, I might add, in the attitude towards monetary policy and financial conditions, so towards the end of last year versus the beginning of this year. If you look at some of the statements coming around the end of Q3, early Q4, there was an acute focus on financial risks, on financial stability. Everyone knows about the conditions in China's property markets. It's well documented. So there was a concern that too much liquidity was going into this sector and the old habits were going to come back. And then towards Q1, there was a bit of a change in rhetoric. It was clear that it would take time for the global economy to heal. So by Q1, the monetary policy statements went towards, yes, focus on financial stability, but also managing the recovery of the economy at the same time. Now, the word recovery is very, very important because the implication is the economy has not returned to full potential yet, not back to trend growth. So easy policy is needed to guide things back. So in this sense, there's not too much of a differential between what the PBOC is doing versus every other central bank on the planet. Now, having said that, we know that since 2008, money versus money policy on the quantitative side versus monetary policy, which is price transmission through interest rates, this has been separated or divorced, as the New York Fed would like to say, for a long time now. So what we're seeing right now is while credit conditions, so credit enhancements, be it spreads or yields, that has been kept relatively tight, and by the PBOC and global peers, there is more of a willingness to crack down on the liquidity aspect side. So be it through open market operations or just outright warning that there are financial bubbles. The chief regulator, Guoshouting, said last week there's a bubbleization and financialization of assets within China. This is a clear message that there's too much liquidity sloshing around, some of it driven due to domestic issues, but a lot of it due to global quantitative easing as well. There's just a lot of money printing going on. Asset allocation shift means that there is money looking for a home. And of course, China is going to be a big focus of that. So how do you manage financial conditions in making sure that the economy can heal, but at the same time ensuring that you don't over-tighten some aspects of the economy such that you force over-tightening and there's going to be a necessary crash at some point? So there are 4 conditions to satisfy. The first one, very relevant for export-driven economies, less so for China right now, but still important for economies with greater global exposure, is the exchange rate. So right now, the dollar is on a bit of a small rally. Dollar CNY is trading above 650 right now. We think that the dollar real yields will probably be capped around these levels. So the exchange rate between renminbi and the US dollar, the renminbi will continue to strengthen throughout the course of the year. I'm comfortable with dollar renminbi falling through 625 and 620, but beyond that, this is going to reach a stage where if we go back to 2013, 2014, where the then head of the State Administration of Foreign Exchange and current PBOC Governor Yu Gang started to talk about the exchange rate being at a fair value. So this is where, when your currency goes beyond fair value, when you strengthen excessively, it begins to import price disinflation. So this is one area where the PBOC will keep a close eye on, but for the time being, it's pretty comfortable. Secondly, equity markets. Well, I would not try to call China's equity markets any more than the next person, and we've just seen the price action today. But this is one area where equity markets higher, where valuations do improve. This is important for a loosening of financial conditions as well. Given there is a willingness to allow equity markets to adjust, which we have seen over the past 2 or 3 trading days, maybe there's a willingness to tighten financial conditions there as well. But again, not excessively. There are reports today that the so-called national team is coming in to protect equity markets as well. So again, one area on top of foreign exchange where they want to see some tightening in financial conditions, but not excessively so. There are 2 additional elements, right? One is yields and 4 is spreads. So on the yield side, here, it's important to look at things on a relative and an absolute basis. Firstly, on the absolute side, 10-year Chinese government bonds right now is at 3.23%. Let's just call it 3.25. Real rates are relatively high. I think for the rest of G10, they prefer to keep real rates at close to 0 or negative. Of course, where inflation and inflation expectations are in China really depends on whether you're a part of the statistics agency or you're the man on the ground, right? So this is a common issue amongst some global policymakers. But I think there is an element, within the general environment such that if your country has a debt issue, which we know China does, then it's important to keep real rates relatively contained. This is where I think China will get plenty of help from the rest of the world as well. As Joyce has already mentioned, there's going to be a lot of inflow into Chinese bond markets. We have seen through our own custodial data that if there's one asset class globally which is absolutely immune to the whims of global risk appetite, it is buying of Chinese government bonds. It is a straight line going from the bottom left to the top right, and that line does not move. Right? So this asset allocation shift into Chinese government bonds, I think, is going to be long-standing. It will be almost impervious to geopolitics, to whatever happens, to risk appetite in the US market. So I think this is one area where I do think, on top of global asset allocation trends and domestic calibration, there will be sufficiently loose financial conditions to ensure that real rates are kept at a minimum. But on the other hand, if you start to allow the exchange rate to import price disinflation and start to limit the inflationary aspect of real rates, then there could be a problem. You might want to move on the nominal, but for the time being, that can offset what's going on in equity markets and in FX markets. The final element is spreads. Again, on an absolute basis, if I look at Chinese offshore and dollar spreads, for example, I think we need to distinguish between overseas borrowing versus onshore borrowing. The PBOC has been very, very clear that they will provide credit enhancement to onshore borrowing. They'll keep front-end rates relatively low. We know that local government bonds, they are tightly managed, the spreads. So it's similar to the situation in Eurozone, where there is sufficient spread compression helped by monetary policy between, say, Italian debt and German debt. It's the same between the provinces and central debt as well. So this is where there is centralized control over the risk premium. However, we do know that there is a lot of overhang. There is a lot of overseas borrowing by Chinese corporates in particular, and they borrow in foreign debt. This is where we would be relatively mindful of some of the risks. And I want to stress, this is an idiosyncratic issue, but it's a global issue as well. Often the corporates borrowing are real estate companies or industries are relatively exposed to investment demand. If this is one aspect of the economy that China wants to crack down upon, then spreads could widen. There could be concerns. We saw this in 2017 and 2018, even short-dated dollar paper by various real estate companies the yield on that, and it went to high single digits or low double digits. The one other aspect, of course, is the global real rate environment. So this is one area where we need to watch developments in the US closely. Today, the House meets, and perhaps it will sign off on President Biden's $1.9 trillion stimulus package. So the risk is that the markets will be fully on board with the US reflation trade. The US's vaccination rates now is topping the global charts amongst developed countries. It's faster than the UK's right now. I believe it's running at around 0.6% of population every day. Of course, it varies behind states. But if the US is going to lead the way for reflation, and the markets for the first time in about a dozen years will start to take on the Fed, then this will have an impact on global high yield, on global spreads, and no country which borrows, be it a public or corporate sector, which borrows large amounts in US dollars will be immune to this. So it's going to be akin to maybe the taper tantrum, but also to the emerging market debt shakeout that we had when US yields were moving higher and when the Fed was hiking rates as well. So these are some of the risks where the PBOC will be mindful that portion of the economy is going to be out of their own control, and they will have to offset that form of tightening and financial conditions versus perhaps a weaker exchange rates or support for equity markets and the like. So it's all about calibration, but we do know that there's plenty of capacity within China, within the monetary policy and also fiscal space. We've just heard about China's growth targets, but also fiscal deficit targets. I've always noted that China's deficit targets would make the Bundesbank proud, right? So more than enough to satisfy the Maastricht criteria of 3% of GDP. That's just the case this year as well. But if your starting point is relatively limited, then there's plenty of scope for fiscal expansion as well, and it will be deployed when necessary. So net, I think I would agree with most of what Joyce has said. So the outlook for China as an outperformer is going to be strong. One thing that I would hope to see some acceleration is the opening of the economy. I think today there was a headline whereby China may have to keep borders closed until 2022, which can be said for countries like Australia and New Zealand as well, where the virus has been eliminated domestically, but they need to wait for the world and to be vaccinated and have a strong vaccination program domestically as well. That's an area where China's somewhat falling short at this point, but I think there is a plan to accelerate our proceedings, and I think that will really determine where things go up ahead. So again, to sum up, it's a delicate balancing act, but there is enough capacity right now to deal with any impending risks. I'll stop there for now, and back to you, Lutfey.
Thank you very much, Jeff. There was a lot in there, but very well structured with your 4 points. My question to you will be also on the risk front. So this bubbleization that apparently is playing out in the equities market, is there a counterpart, or is there a bubbling counterpart in the fixed income market there? And so, whenever I hear that something is immune and impervious to everything that's going on, the question always is there a tipping point where things could start to wobble? Or is the best case outcome that money will find its way into the new dual circulation shape of the GDP? So your thoughts on that, I'll come back to you in a moment. Joyce, if I may come to you with my question about how you see imbalances playing out in the form of a tail risk.
Thank you very much, and I will take that question, but also add a few comments just to the points that have been made by Geoffrey and Laura as well. So we do see that China has increased its debt burden by about 25 percentage points of GDP. So by estimates, this has China's debt at over 300% of GDP. And their Achilles heel really is the state-owned enterprises, which are in need of reform. And you had that this was a year where you actually had more jobs created in the private sector, that 80% of the state-owned enterprises are seen as less profitable than private sector companies. We do think that China is actually looking at the U.S. putting its foot on the pedal on the fiscal side and actually trying to do the opposite, really proceed more with normalization. So we are looking at a fiscal drag this year that's about 3.1% of GDP, whereas we had a fiscal impulse in China last year that was 4.8% of GDP. And we have credit growth coming down from 13.5% to an 11.5%. So I think there is awareness on the part of policymakers that they don't want to get into, a situation that, creates more concerns about whether, bubbles are emerging right now, which is very much the debate that is playing out in the United States. But I thought, with a lot of Geoffrey's points, I mean, we actually have very similar views on China, but I thought I would just make a few comments, related to what he'd said. So your whole question on whether you are going to see, a bubble in the bond markets. First of all, with 97% of developed market central banks with interest rates at under 1%, there is a search for yield. China's owned by 3%. It is going into the indexes. And very much on the points that all of the speakers said, there's a sense that you're underallocated to China now, underallocated to emerging markets. So I do think that you're going to see that demand increase simply because of the search for yields. And I think that China will be under pressure to bring rates down because of the size of their debt burden. You have 300% of GDP as your debt burden, you will not be able to, you're going to have to really balance that. So I do view that, much as Geoffrey has mentioned, as more of a structural trade that's in place as China matches the size of the U.S. economy, has the second largest bond market, offers a pickup in yield, is under-owned, and also under its own domestic pressure to bring rates down even more given the size of its debt burden. So would just say that that's my view on that. One thing I would just say on the digital currencies is that you do have a situation where the innovation is outpacing regulation. And the way that we look at the digital currencies at JP Morgan is that all digital currencies, private sector or central banks, should have liquidity savings mechanisms as part of their liquidity design. So if you take a look at Bitcoin, for example, what we saw in March when we had the US Treasury sell off, the safest bond market in the world and the largest bond market in the world, is that you couldn't even transact 150 million a day. So if you take a look at what the risk could be to Bitcoin, if you had a sudden loss of confidence in USDT, a stable coin that's issued by Tether, that Bitcoin really relies on for 60% of its trades, that could be a severe liquidity shock to Bitcoin markets. Now, I'm not saying that's going to happen, but if you can see a liquidity shock to treasury markets, why can't it happen to other asset classes? And it's very much along the points that Geoffrey has made. Will there be a taper tantrum? And I don't see a taper tantrum. I see a couple of important differences to the taper tantrum as far as the scope of what we saw. The fears of rising bond yields will stay, but in the taper tantrum, you really had that you were probably 50 basis points below fair value when it started, and now you've actually had the whole move. You've had more of a move than you had during the taper tantrum already, just given where yields are at. And I also don't think you had quite the positioning in emerging markets that you had before the taper tantrum, which was very elevated. So just going back to the point on regulation, I think that there's a couple of things that will need to play out. Since stablecoins aren't considered deposit, they may not be required to be insured by deposit guarantees like the FDIC. So there's a number of questions. Who has access to the Federal Reserve payment system? What's the appropriate level of oversight and regulation? What liquidity facility should be required? But very much, as Laura said, fintech has come into the mainstream, and it's here to stay. And you can really see this when you look at who's applying for bank charters. I mean, in the Office of Comptroller in the US, of the 10 companies that applied for bank charters, there's much more in fintech. If you look at the, we've been going cashless anyway, but this was accelerated by the pandemic. But if you look at the market cap of big tech since 2018, it's risen by $4.2 trillion. The big banks have actually declined by $340 billion in that same period. So we really do have a situation where fintech has gone mainstream, but the same things that we've seen in other asset classes, liquidity facilities, regulation, the oversight, all things that were tested in the global financial crisis at the start of this pandemic in March, when the Fed and other central banks had to step in, those are still tests that all asset classes can face, and that's why I think the design and the liquidity savings mechanisms are very important.
Just on taper tantrum, since you made that comment, Joyce, do you think, just zooming out of China for a second, that central banks should hold their nerve and allow the yield curves, developed market yield curves, to normalize, or should they respond to it in the way that they did to the taper tantrum in 2013?
Well, look, I do just think that the amount of debt that has been accrued, is going to put some limitations on, central banks and, to how quickly they can move and how quickly they can respond. And they're using a combination of, forward guidance, yield curve control, and Japan, other things. And I think, that's the U.S. has gone to an average inflation targeting and has said we're going to overshoot. Our forecast for second quarter U.S. growth, I mean, if every $1 trillion of stimulus adds about $4 to $5 to EPS, you've had 1.9 trillion that's going through. There's probably another 300 billion going through in infrastructure spending. So we have second quarter U.S. growth at 9.5%, and 8.3% in the third quarter. That's the fastest growth rate in 50 years. Right. So that's going to outpace what China is growing. So these fears on rising yields and inflation are not going to go away anytime. Right. We've also raised the commodities forecast because we had thought that you might see some change in OPEC strategy, but they didn't change it. So we do have oil now going to $74. So those concerns, like, is this going to be the taper tantrum? What's going to be similar? What's going to be dissimilar? What's dissimilar is, like, you've already had a big move. You have had more flexibility introduced by the central banks, but nonetheless, I mean, it's already taken its toll, and I don't think that's going to go away as you see U.S. growth numbers, accelerate as the stimulus comes online. Those fears are very much going to stay with us.
So the reflation trade seems to now be on.
Well, it's a story, it's been more though of a story of last year, China exceptionalism, first in, first out, really the first complete recovery, and U.S. exceptionalism this year because of the size of the stimulus as China is pulling back.
Right. Thank you, Joyce. That's a great way of putting it. Lucy, if I may come to you now. I think my question was, can you have public sector digital and private sector digital cohabit in China?
I think the answer in China is that that's probably not encouraged, sort of a spectrum from not encouraged to moving towards an outright ban on any tokens that are not centralized from the PBOC. I think, when you get to a situation where money and state, that relationship is starting to be challenged, and the strength of that relationship is suddenly looking, weakened by the technology. There are moves to really clamp down. I mean, China banned Bitcoin back in 2017, but now it looks like they're making moves to close a lot of the Bitcoin mining operations down, which normally it had turned a bit of a blind eye towards. So it looks like it's getting a little bit more tough on any kind of money that is not public money. And when I say public, I mean public controlled by the PBOC. But, my personal view, I think the genie's out of the bottle. I think it has to be managed. I don't think it can be stamped out. We saw crypto and Bitcoin was banned in Nigeria and usage went through the roof. So, it's very difficult. I think decentralization is an extraordinary threat to everything, to financial systems, talking about liquidity savings mechanisms or liquidity in a centralized system is very different if you have decentralized solutions that can sort of disperse any single point of failure. When you've suddenly got all the innovation that's happening in DeFi, what is identified as potentially a point of weakness in the payment system with liquidity or whatever it may be. There are so many decentralized solutions that you can have to solve it, right? The innovation is just unreal right now. So it seems like there's no problem that can't be solved. And therefore, for me, that means this innovation, when it comes to the transfer of value around the world, you know, there's no limit to where we're going to get to. So I personally do see a world where a lot of different tokens, if you like, are used, and somehow collectively as a global society we come to some sort of agreement as to what is the most powerful, you know, payment instrument. You know, a lot of the criticism about Bitcoin, it's like, well, what does Bitcoin give you? Great, it's decentralized, but who's going to protect you with armies, you know, when you're linked to a nation state? And so money plays that role, right? When you're believing in the US dollar, or you're believing in the ERMB, you're believing in the governments that back those currencies. So I think for now they're gonna reign supreme, but it's going to be a tough time.
Okay, thank you, Lucy. Jeff, so my question to you is about risks in the fixed income market, if you see any, but if you have a view on the digital currency thread as well, please feel free to jump in.
Right, sure. So I think, again, from the fixed income market, yes, there will be outstanding concerns over the sense that the debt buildup in China is going to be excessive, especially on the corporate side. And when we talk about risk premia, for example, at what point, and will a lot of the contingent liabilities, and given a lot of the debt will be linked to local provinces, local governments, or even state-owned enterprises, do they actually become realized liabilities? Because if you look at China's national debt to GDP ratio, it's probably lower than most of the European peers and those in the OECD. But if you start to count contingent liabilities, then it becomes a different picture, and then that's when the entire credit curve starts to shift, and then maybe the straight line I mentioned from bottom left to top right becomes a different situation. But I think this is a bit of a tail risk. The broader shorter term risk is, as I mentioned earlier, if US real rates have continued to move forward and the markets fight the Fed and actually win, or the Fed actually starts to buckle a bit. Just to be clear, I don't think this will happen. Maybe yield curve control is something that the Fed will start to look at before that will be allowed, because it impacts US financial conditions as long as global ones. But if there's a loss of control, if that starts to spread into emerging markets, and I totally agree with what Joyce said about the positioning aspect, there may be more limits as to how volatile it will be, but it's about the known unknowns, right? We know that there may be unknown pockets of debt overhang that we don't know about, and if that leads into systemic issues, then it could be a different picture. On CBDCs, one thing that excites me greatly is what Andy Haldane, the chief economist of the Bank of England, talked about as the removal of the zero lower bound problem. Right, so sorry, the zero lower bound problem in the crudest sense, right? Why a lot of central banks, especially those on savings light economies such as New Zealand and the UK, why they don't want to go negative is if you apply negative rates, if that's passed on to retail will just start to take their take their funds out of the banks, put them under their mattresses, and then it's like a short-term bank run, and this will cause severe issues for the commercial for the retail banking system. Right. However, right, how do you avoid this? If it's a digital currency, right, then no matter you can't physically hide your savings. Right, you can hide it. It's base money, it's M0, so it will be stuck in your wallet, and the bank and the central bank can apply a negative rate to that. So central bank can apply as low a negative rate as you want, right? And there's also this concept of programmable currency, as Lucy mentioned. Now, if you think about negative rates, it's not negative 1% or 2%. Also, if you think about it in this term, how do I encourage people to spend, right? Then if you say, I'm going to program base money such that this will disappear within a month unless you spend it, right? So if it disappears in a month, it's equivalent to a negative 3% daily interest rate. After 30 days, it's gone. And then I program it further. I live in Kent, right? So if Kent's economy is doing poorly, but Teesside's economy is doing well, then your digital currency can only be used in TN postcodes around Tunbridge, for those of you who know your geography, right? So that can boost the localized economy. So these are some of the fascinating propositions on a micro level for central banking, which I think will excite central bankers. But again, there are other sides of the issue which we don't need to elaborate on. But I'm more excited by these propositions from a monetary policy point of view.
Thank you so much, Jeff, and thank you to the panel. We've almost come to the end of our time. Before we leave, I just want to take what Joyce said at the start, which is that China GDP should match the US GDP level by the end of the decade. And a question from the audience, from Muhammad Dawani, LSE Ideas alumnus, who's asking about the yuan floating currency, ultimately a reserve currency. So my question, almost a yes-no answer to the three of you is, do you think at the end of the decade, the yuan will be a floating currency and a reserve currency? Jeff, you have the mic, so yes, no from you first.
Right, so will it be a floating currency, greater float, so more, so yes, the market will play a dominant role in determining the value of the renminbi. It already is a part of the SDR basket, but greater reserve holdings, a lot will depend on deliverability, and that I think may be a step too far at this point.
Joyce.
No, I agree with Geoffrey, and we actually have similar forecasts. I mean, we have CNY at 6.35 this year, sort of in this range. They've been allowing greater flexibility over the last couple of years, but with respect to full convertibility, look, even the process of having them achieve index eligibility, we needed to see the greater flexibility. I mean, which has been, a slow process. I don't think that China can, given the size of its debt, move that quickly. And you still have, looking at the errors and omissions lines, capital outflows. Right. So I don't think that they will be able to achieve that by the end of the decade, but they have achieved greater flexibility enough that they are going into all of the mainstream indexes and will be a mainstream holding by the end of the year. And very much, with Lucy's point, the fintech is also here to stay. They need to figure out the regulation, but I do think it's here to stay. So just, a pleasure to be with Lucy and with Jeff on this panel and with you.
Thank you. Lucy, you have the last word.
Yeah, for me, I think the whole concept of a reserve currency needs to be, rethought, actually. I don't even know if there's going to be a case for a reserve currency by the end of the decade. I think we'll have moved on so far. I think our economies, our global economy is going to be interconnected beyond our wildest dreams. And if I had to put money on it, I'd say Bitcoin is going to be the global reserve currency, and or some kind of global currency which is agreed upon by a number of different countries. But I don't see one nation taking the title.
Wonderful. Love that. I love the diversity and the energy in the answers today. So thank you so much, Joyce Chang, Lucy Gazmararian, Geoffrey Yu. Thank you so much for joining us. Thank you to the audience for being here with us today. A short feedback form will appear in your browser when the event ends shortly. We'd be grateful if you could please take a minute to fill that out. Until next time, take care. Bye-bye.
Great. Thank you so much. Thank you.